Hi, I'm Walker&Williams, and today I'm going to be giving you some mortgage advice. But please don't fall asleep. It's not the typical mortgage advice, and I don't believe it's mortgage advice you're going to get anywhere else, and I promise this video will be short and hopefully you'll find it interesting. Please, if you already own your own home or you're planning on buying your own home, please, I implore you, watch this video all the way through. Not for me, I already know this stuff, but for you. And then if you want to ignore me, that's fine, but just hear me out. It's really, really important. And actually the way this video came about was because I meet a lot of young couples or couples of a similar age to me at my children's parties, you know, at different events, at social events, solicitors, house parties, all that sort of dinners and that sort of thing. And it's always the same story. You know, mid to late 30-year-olds, one's a nurse, one's a teacher, one's a doctor, one's in the army, decent, really nice, good, genuine people. And they just haven't got a clue about finances because it's not taught in school, it's not really taught anywhere. And so when they find out that I have the YouTube channel and I give people crypto advice and that sort of thing, they get really, really excited. And it's usually the man, not always, but usually the man if it's a male-female relationship. It's usually the man that will say, or he'll sort of puff his chest out, dead proud, and say, well, here's one for you. We've been paying off our mortgage early. 10% maximum is the maximum you can do. And we've been paying off the maximum for 3 years now. And I'm devastated for them. I'm absolutely devastated. And this video is going to explain why I'm devastated for these really, really decent people. Okay. So if you were to go and get a residential mortgage today with HSBC for £150,000 over 25 years, it would cost you £606 per calendar month, PCM per calendar month. The total payable, so if you made every payment of £606 per calendar month over the 25 years, the total payable would be £236,331.85, which means you only borrowed £150, don't forget, that £84,782.85 would be interest, £1,499 would be fees, and £50 would be admin fees. Now, it's worth noting that with all mortgages across the board that I know of, you can pay for free, they won't penalise you or charge you, up to 10% of the total of your mortgage off every year. So if you've got a £150,000 mortgage, you could pay it off in 10 years. If you have a £1 million mortgage, you could pay it off in 10 years without incurring any fees. Any quicker than that, and they actually charge you, they penalise you for doing so because the banks don't want to be paid back. So they penalise you for doing that. But 10% has been deemed fair. You can chip away at your mortgage 10% per year for 10 years and you've paid it off in full in 10 years, which means you've saved 15 years of interest. Sounds good. And why wouldn't you want to do that? I'm going to get there in a second, and believe me, I think if you believe that's the way to go, I hope I can change your mind. So, so £84,000. So you can pay 10% off without incurring any fees, and I've met loads of young couples who say, we've had a house for 3 years, and every year we've gone without, and we've managed to pay down our mortgage by the full 10%. For 3 years, and if we just go without, if we eat cornflakes and wet bread for the next 7 years, we'll be mortgage free. Debt free, they say. Okay, this is the problem. That represents, so that deal there, the £150,000, £606 per calendar month, that represents an APRC of 3.9%. What's APRC? It's annual percentage rate of charge. That's not to be confused with APR, which is annual percentage rate. The difference is that if you take out a credit card and they say 36% APR, it means that every year they're going to charge you 36%. So if you borrow £100, by the end of the year, you will have paid £36 in interest. Same for next year, the year after, until they change the APR. So the APR is dead straightforward. With residential mortgages, it's slightly different. It is an APR because it is 3.9% APR, but the way they charge interest and capital is different. Now, I'm willing to bet you don't know this. Even if you're a seasoned investor, a buy-to-let landlord, I've got a friend who's got over 100 properties buy-to-let, and he didn't know this. So I'd be amazed if you know this. Your parents won't know this. Get this, right? The banks aren't stupid. HSBC, all the other banks, these residential lenders, they're not stupid. So they know that if you take out a 5-year product, in 5 years you might be with somebody else. So they're not going to say, okay, well, the mortgage is 25 years, it's 3% a year, so every year you pay 3% interest. That's not how it's worked out. It actually works like this. So the red amount that you see there is interest, and the blue amount is capital. So the first month you make your mortgage payment, your first payment of £606 per calendar month, the first payment, on this example it's a £600 mortgage, £599 of it is interest and £1 is capital. On the very last payment, in 9,125 days, which is 25 years, at the end of 25 years, the last payment on your mortgage is it's the other way around. It's £599 in capital and £1 of interest. Why do they do this? They front load the term with the interest, meaning they put all the interest, a thick bit up front, rather than just having it as two straight lines 50-50. Because if you're only with them for that long, 5 years say, that's roughly 5 years, look how much interest you've paid them, and you still owe them all of this capital. So the thicker this wedge at this end, the more interest you pay, and that's how it works. So that's why it's not APR, it's APRC, because the banks then say, well, on month one, you're paying 99% interest and 1% capital repayment. At the end of it, it's the opposite. You're paying 99% repayment and 1% interest. But across the whole thing, it balances out and represents 3.9% a year. So if you stuck with this the entire way, it would equal out at 3.9% per year. But in actual fact, year one, you might be paying 70%, 80%, 90%, and depending on the deal you have, every deal's different. And in the last year, you might be paying 1% interest for the whole year. So the banks aren't stupid. So really important to understand that. It's really important that you're heavily weighted up front with the interest. Now, it might not be as stark as this, but have a look at the small print in your mortgage, if you have one, and it'll tell you how much of the interest is charged up front and how much is on year 25. And I think it'll blow your mind. Okay, so that's the difference between the APRC and the APR. So why was I devastated when I found out this couple? I really, really like them. Why this couple? Why was I devastated that they'd made 30% of their, 3 years, 10% per year, so they've paid off 30% of their mortgage early? And basically in one sentence, because it's the cheapest money you will ever get to borrow. Excluding, obviously, friends, family who lend you money for nothing, here's 20 quid, pay me back when you can. Except for that, I'm talking like formal deals where you go to the bank or your credit card or HP on your car or PCP on your car, whatever it may be. Your residential mortgage is the cheapest by a long way, the cheapest money you will ever borrow. So why am I devastated? Okay, reason number one, inflation. If you go on Google, and it doesn't matter which country you're in, if you're in America, no problem. Go on Google's. Type in Bank of England inflation calculator, and all of the first page is the Bank of England. Okay, it's the official website of the Bank of England, and it comes up with 2 bars. Okay, and in the first one you type a number, and then you can choose times. Okay, so let's say that we took this £150,000 mortgage out in 1994. What is that money worth 25 years later in 2019? That £150,000 has been eroded away by inflation to £74,848.59. Okay, Mike, so I've gone cross-eyed. What does that mean? Okay, what it means is, if you took out a £150,000 mortgage 25 years ago, today, if you've made no payments whatsoever, or it was interest only, and it just sat there, the capital, your mortgage didn't move. You didn't go without. Instead of paying 10% a year, 15 grand a year, paying it down, you just went and spunked it all in the casino, on holidays, whatever. If you did nothing with the mortgage, inflation alone has halved just under halved the mortgage for you. The value of the money is depleting every year. I'm not going to get too bogged down with inflation in this video, because I've done another video previously. If you want to know more about inflation, and I hope you do, because you have 3 choices in life. Number one, you can occupy Wall Street. You can scream and shout and hold up placards saying that the rules of the game aren't fair. Okay? And I agree. Inflation is daylight robbery. It's literally theft by governments. Okay? Literally. It's a tax. It's a stealth tax. 100%. You can stand outside, occupy Wall Street, stand outside a cathedral or whatever with a placard saying the rules aren't fair. The rules of the game aren't fair. That's option number one. Option number 2 is do nothing. Just be ignorant to it. And just struggle far harder than you need to. Even if you're making good money, it's not how much you make, it's how much you keep. So you could just ignore the videos like this, which I guess you're not the kind of person if you're already watching this video, but the option number 1, Occupy Wall Street, multicolored mohawks. Rules aren't fair. Option number 2 is do nothing. Just play the game safe, just pay down your mortgage as quickly as you can, get a job, retirement, pension, and all that sort of stuff. Don't worry about inflation and don't educate yourself. Okay, so be ignorant. That's rule number 2. Rule number 3 is, and this is what I suggest you do, learn the rules to the game and then play the game according to the rules. And if you know the rules and you know what works and what doesn't, and you know what you should do and what you shouldn't do, you can win. It's not that hard. And somebody who knows the games, the rules, will end up keeping more money if they're on 40 grand a year than somebody who doesn't understand the rules of the game, who's on 400 grand a year. It's not about how much you make. I mean, it is to a degree, but it's more about how much you keep. Okay, so if you want to know more about inflation, have a look in the description below. I'll put a link to that video there, and you can watch inflation, and I actually show you the website and show you how to use it. Really, really interesting. And by the way, to put this in real life, stark context, my dad is 85 and he bought his first house for £7,000. Okay, he bought his first house for £7,000, and you all have relatives or friends or relatives of friends or whatever who've got a similar story. My dad's first house was £7,000. He had a £5,000 mortgage, and you have to bear in mind that at the time he was earning about 15 quid a week. So he's earning 15 quid a week, he's got a £5,000 mortgage. Imagine if he hadn't have paid it off early, hadn't have done anything, and today decided he was going to pay it off. He could pay off his entire mortgage for £5,000. And he hasn't never paid a penny. It just sat there doing nothing. Today, his entire mortgage to pay off his house and be debt free would be 5,000 quid. And all he's had to do is wait. Just hold the money there and wait. To put it the other way, by the way, if in 1994 you earned £150,000 a year and you got pay rises that just kept up with inflation, today you'd be paid £300,606.86. And another small point, this is according to the Bank of England, and they have the inflation rate at between 1994 and 2019, they say the inflation rate's an average of 2.7%. I think it's more like 5, but that's a whole other thing. So just let's assume that their figures are correct, which they're not, but let's assume they are. It's much worse than they make out. Your £150,000 mortgage, if you do nothing, will be worth £74,848 if you do nothing over the 25-year period. Number 1 reason not to pay it down, because inflation will do it for you. Number 2, and this is the really important bit, savings and investments, okay? So, in fact, I'm going to get to that in a second. I'm going to do expensive debt first. A lot of these couples, and it blows my mind, they're paying down their mortgage, which if they keep with the same people, if they keep with HSBC over the 25 years, it's costing 3.9% a year. But they've put 15 grand in to do that. And then because they haven't got that 15 grand, or they're a little bit tight, or one of them loses their job, they go and get a credit card to cover the shortfall. And the credit card's charging them 40%. So they're paying down debt that's costing them 4%. And when they run into trouble, or we hit an economic crash like we did in 2008, like the one we're due very shortly, they hit that, one of them loses their job, and all of a sudden they've taken out a personal loan, a payday loan, a Wonga loan, a credit card. Some of them, they haven't even hit hard times. I met one guy who was single. He'd bought his house. It was actually a flat, 2-bed flat. And he was dead proud to boast to me that he'd actually paid some fees, because he'd paid more than 10%, and was absolutely, in his words, smashing it. He was destroying his mortgage, smashing it to bits. Then we go to pay for drinks, and he brings out an MBNA credit card. And I say, oh, do you pay it off every month for the air miles or whatever? He said, no, just helps me carry month to month. And I'm thinking, this guy is paying 40% to MBNA per year and killing himself to pay down his 4% debt. It literally, it's as simple as that. It makes no sense, mathematics. So if you are paying down or thinking of paying down your mortgage and you have credit cards, hire purchase on a vehicle, which is about 7 or 8%, 9%, 12% if your credit's bad, or PCP on a car. If you've got finance for a wedding, that's a thing now. Holiday, so if you're paying a percentage on your holiday, so you pay for your holiday in 12 equal installments, and it's 12% APR, then you're paying 12% for the holiday. when you could be using the money that you're paying down the 4% debt with, and effectively, make yourself 8% or save yourself 8%. And saving 8% is the same as making 8% for the purposes of this conversation. Now, this is the really important bit. Investments and savings. So let's say, for example, okay, we've got two options. These are our two options. Option number one is to pay off £15,000, which is 10% of a 150 grand mortgage, pay off 10% per year, 15 grand per year, off the mortgage, or we can put that £15,000, that 10%, into a savings account that compounds. Okay, let's assume for a second that we only get 5% interest per annum. And if you can't get more than that just from doing a little bit of research, then go back to sleep, I guess. So £15,000 per annum for 10 years, which is, you're going to pay off your mortgage in 10 years, 10% per year, 10 years. You get £15,000 per annum for 10 years. How much would you earn in interest? £49,399.87 is how much you would earn in interest. And if you were to pay off your mortgage in those 10 years, you would save yourself £50,869. So they're about the same. But that's assuming that you're getting 5% a year interest. Now, if you let your mortgage run for the full 25 years and you only earn 5%, you let that compound, you'd make £389,701 compared to the £84,000 that you'd save. So if you say you could save £50,000 by paying off your mortgage 10 years early. If you let your mortgage run and instead put 15 grand a year for 25 years, the length of your mortgage, and let it compound, at the end of that 25-year period, you'd have £389,701.30. Enough to pay off the mortgage in full, and you've still got a load of money left over. Except you've been paying off the mortgage anyway in slow, small increments. Now, this is the really interesting bit. If you watch my channel, you know my stuff, you know that I do a lot of property development. When I get bridging finance, I used to pay for many, many years, I paid 12%. And actually sometimes, if it's a particularly tricky or complicated deal that only a few bespoke lenders will do, I still pay 12% per year. I'm paying 12% on 5 or 6 or maybe 8 different loans right this second as I'm making this video. I am paying 12% on some of the stuff I've got. There are guys who pay 16% because they've got bad credit, because they haven't got a history with doing it. They're riskier, so the loans are higher. But they are riskier. They're a riskier bet. A guy who's never done a bridge loan before, never done development before, he's going to be at higher risk to you as an investor than I am, who's got the track record. But even I, with experience, I'm paying 10%, 100, most of the time, and I even still pay 12% myself, even though I've got over a decade's experience in the industry. Let's assume for a second that you lend me 12% per annum, which I would borrow with some properties, like I say, with some deals. I've got a deal coming on now in Chorley at the moment. I'm borrowing, it's costing me 12%. So 12% over the 10 years, bearing in mind that £15,000, I'm saving £50,869 and 71 pence on my mortgage. I'm not, by the way, because it doesn't quite work like that. But let's assume, let's give the mortgage idea the benefit of the doubt. Let's give them the best chance of winning, because it's actually, you'd save about 40 grand, not 50. But you're saving £50,869.71 because you're saving 15 years of interest by paying off your mortgage in 10 years. 10 years at 12%, you'd make £156,579.88. So if you lent me £15,000 this year, and I paid you 12%, and the next year you lent me £30,000 and I paid you 12%, and so on and so forth, and you compounded it, and every penny I paid you in interest you lent back to me, and then I paid you interest on that. After 10 years, you can either save 50 grand or have 156 grand in savings. 3 times more money you've made than you've saved. This is the really big one. Get this. This is the power of compounding. Einstein said that compound interest, or compounding in general, compound interest is the 7th wonder of the world. Or is it 8th? 7th or 8th wonder? I don't know. Let me know in the comments below. Okay, so 12%. So Max, I want to lend you money. Hi Max, love the video, blah, blah, blah. I'd like to get involved with the property scene. I'd like to lend you money. I'd like to lend you £15,000 at 12% every year for 25 years. How much would Max pay you in 25 years over the period in interest? £2,128,998.70. So you can save, this young couple, this wonderful young couple are going to save £50,869. That's amazing. Well, you're nuts. Pay down your mortgage as quickly as you can. Or they can lend it to somebody like Max and make 2.128 million. Now, of course, there's risk. The Max goes bust and you lose your money. Of course there is. And there's less risk with this. But £2 million versus 50 grand? Okay. If you aren't interested in having savings with Max by investing in Max or crowdfunding or whatever, and you can Google crowdfunder pages, you get great returns on there, and your money is less exposed because they spread the risk. But you don't get quite as good a return. You might get 8%. So you only make $1 million instead of 2 million. But as opposed to saving 50 grand over 25 years. The other thing you could do is invest. Don't lend the money to anybody. Let's say, for example, okay, instead of putting £15,000 to pay off your mortgage year one, £15,000 year two, £15,000 year three, year one, you put it in a savings account that makes you no interest whatsoever, okay? Year one. Year two, 15 grand into the same account, you've now got 30 grand, no interest. Year three, you put another 15 grand in, now you've now got £45,000 in your savings account. You didn't give it to the mortgage company, you just kept it in a savings account that pays you no interest. You could then use that as a 30% deposit on a buy-to-let property. You could then go and buy a buy-to-let property, and £150,000 a buy-to-let property in Preston, you're going to be getting about £650 per calendar month. And from that, you'd net about 20% profit. So let's say you managed to buy 3 properties over 9 years. So year 1, year 2, year 3, £45,000 deposit. Year 4, year 5, year 6, £45,000 deposit. Year 7, year 8, year 9, £45,000 deposit. You've now got 3 properties. In 9 years, you've got 3 properties, and each property brings you in £600 per calendar month. Obviously, the rent would go up over the years, and it would probably start off at £650, not £600. But to give you an idea, you'd be making £1,800 per calendar month. You'd be netting about £360 per calendar month profit, and you'd be getting all the capital appreciation. Now, if we go back to inflation, let's just say that the 3 properties you own, let's say you once you've bought the 3rd one, forget all the time before then, just 25 years moving forward when you're looking to retire, and let's assume that the properties have just kept up with inflation. Now, we all know that that's not the way it works, both in all countries, America, UK, property prices, they drop, sure, but they always go back higher, and then they drop back, and then higher, and drop back. Let's assume that they do none of that, and there's no capital appreciation, other than just they keep up with inflation. So money is wasting away, as they say in America, cash is trash. Money is rotting away because of inflation, but the properties keep rising in value, a bit like the price of gold, the price of toothpaste, everything keeps getting more expensive because it's keeping up with inflation, and property does the same thing. Your £350,000 properties would be worth £300,606 each. So, you don't even have to lend your money to strangers, just buy your own buy-to-let properties. If that doesn't interest you, too complicated, because it's not as simple as that, of course. You've got to manage the properties, you have voids, you'll have a tenant who smashes the house up. So of course, none of this is as exact as science, but you get the premise. Paying off your mortgage, if you're going to have any form of debt, and you've got any sense of brain, is a crazy, crazy thing to do financially. Because put simply, it's the cheapest money you will ever be lent in your life. And if you think you can earn more than 3.9% per year, then don't pay off your mortgage early. Use your hard saved money to pay for something else. Or just enjoy your life and let inflation do the rest. I hope you found this video informative. Thank you ever so much for watching. If you've got any questions whatsoever, good, bad or ugly, leave them in the comments below. There's no such thing as a stupid question as far as I'm concerned. I mean, there is if you're an idiot, but you know what I mean. If you've got a genuine question, but you're embarrassed or it seems a bit obvious, I don't understand what APR means, just ask me in the comments below and I will come back to you personally. Thanks ever so much for watching. See you again soon.